Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today we have a lot to get into with just this, the action that we're seeing in the market this week. Certainly we've seen significant downward pressure being placed upon stocks, particularly in the market. I saw this headline yesterday. So we just had the anniversary on October 20th of Black Monday in 1987. That was when the Dow Jones was down a whopping 508 points for that trading day. Was actually a pretty big deal at the time because it represented 20% of the Dow Jones index at that time. 500 points a day. We could drop that between breakfast and lunch right now, but back in the 80s it was very significant. And it's interesting because what was traced back when they did a lot of research to kind of see what happened that day, computer algorithm trading was really just kind of up and coming, and they were able to look back and really kind of point the finger that it was likely some of those algorithms are responsible for the decline that day. But as a result of Black Monday, we implemented something called circuit breakers. And so with the circuit breaker, if the market drops 7% from its open, then we have an automatic pause in the market where trading is halted. The idea is to try to give the market a breath, a chance to kind of pause before, and then catch up. And so we actually triggered multiple circuit breakers back in February as the pandemic began prior to the crash in March. And so just thought that was very interesting. So 508 points, that was Black Monday back then. Right now we're down about 850 points on the Dow today. That represents about 3.3% right now, give or take, depending upon what happens while I'm taping this. But so that's kind of just an interesting little part of history. This morning, at market open at the bell, the heat map, you can see very much so negative market sentiment. This is the S&P 500, and there's a lot of pressure right now in the market. We're going to get into there's a couple of reasons why I think we're seeing so much pressure kind of happening within the market and why investor sentiment is somewhat negative for now. So let's get into some of the technicals here. So for the S&P 500, so if you'll remember back in September, we had kind of topped out like right September 2nd. We were in a downward trend the entire month of September. When we picked back up, you remember, if you've been with me now for a while, you remember what I said. I said if you were uncomfortable with what happened in September, if you didn't really like how that felt, you probably had too much risk in your portfolio. I said we're going to see some upturn over these next couple weeks likely. Take that opportunity to scale back your portfolio, maybe bring in some hedges, maybe some bonds or some cash. Consider maybe taking some profits, get rid of some of your laggards, clean up your portfolio, tighten it up. Because I said that it was very expected that we could see a bumpy ride coming into the election, and that's kind of now what we're seeing now. So we saw this upturn here, and now we've really been on a steady decline. Now, everything was going very orderly. Everything was kind of going in turn, nothing unexpected, up until today. Today's price action is pretty, I would say it's extreme, even for in the downturn that we're kind of experiencing right now. Market's been hovering between about all three indexes down 3 to 3.3%. So here's our 50-day moving average, this blue line. Remember, moving averages, they act like a magnet that we tend to trade above or below, very close to them. They also act as lines of support for us. And so you can see on Monday we violated the 50-day again, and then we closed below it again yesterday, and I think it's very fair to say we're going to close fairly sharply below the 50-day again today. You can see this is how it acts as support though here, because see how we consolidate and we traded real close to this line here. That's kind of how that works. When we got super deviated, now back here I was giving warnings, hey, we're really diverged from our 50-day. A rubber band, you can only pull it so far before it eventually will finally snap back and go the other way just as hard, and that's what we saw in September. So we were super diverged here from our moving averages. We weren't quite as diverged here, and again, this was really just, I think, the rally that we saw was kind of expected. A lot of that was stimulus driven. So this rally was really driven on hoping we would get stimulus. And if you remember, last week I told you that markets were either going to react positively if we got stimulus, or they were going to feel very negative if we didn't. So we'll talk about that in a moment. Here's the Dow Jones, same thing. This is going to be the beginning of September. Pretty orderly decline here. Then again, we hovered over the 50-day for a while, and then here comes our decline, and then our close in again. We will close sharply below our 50-day again today. So something to note, so our next line of support is going to be the 200 moving day average. Now I'm not saying that since we've broken below here, now we're going to crash down to that next level. just saying that's technically our next line of support that we have to watch very carefully to see if we approach it. You can see we actually weren't too far from it back in September, but we did stay above it, which was a good thing. So these are things that we're watching and looking at now. So what's happening in the market? Well, it really depends on what headline you read, because every news or headline is going to have a different reason. And a lot of the times, it's not so important as to what's causing it. As we watch the technicals in the background, as we see the changes happening, we respond. But there's a couple things happening right now. So number one, this market has been driven by a greed-induced frenzy thanks to stimulus and thanks to Fed intervention. So much of the rally that we saw back in April was related to we were getting stimulus, so we were getting checks to households. We had programs like the PPP programs that the government was kind of throwing money in the market. The Federal Reserve was adding liquidity in the market. They were buying up bonds, they were buying up ETFs, really kind of saying like, hey, we're going to support this market. And so really though, here's the negative thing that happened. It caused a lot of investors to kind of say, I'm not going to care about anything else, nothing else, everything else is on fire, but I'm going to kind of ignore it because we've got stimulus and we've got the Federal Reserve saying that they're going to support us. And so now the Federal Reserve recently said there's really not a whole lot more at this point we can do. And really, what should they do? Markets for a little while were at all-time highs for a little bit. So from a Federal Reserve standpoint, I think they kind of realized the waters have become so muddied because of their intervention. They kind of need to step back a little bit. And then now to not get the stimulus, I mean, this whole run up here just a couple weeks ago is because, remember, we kept hearing, yeah, we're getting closer to a stimulus deal. We're going to go back into talks so the market would rally. And then obviously the Senate was just adjourned through to the beginning of November. So certainly the chances of getting stimulus passed before the election is null. And I would say at this point, probably January will be the first that we'll be able to possibly get some sort of stimulus package passed. And I think the markets are going to struggle with that because that means they got to deal with a couple of other issues that they haven't really had to deal with coming up to here. So let's talk number one. So we talked about stimulus. Number two, we are coming into an election that will likely be contested. I mean, I think that most people would agree. Obviously, these are definitely times that we've never had before. This election is going to be as such also. And so the last time that we had a contested election was back in 2000 with George Bush. Remember the recounting that had to happen in Florida. And so that was a pretty negative time for the market as well. So this is going to be at the beginning, right at election day. And then you can see as the contested, it continued. We bottomed out about 7.6% from the market high to the bottom during that time. And then we began to recover, and then this would be when the Supreme Court made the ruling. And so we can kind of extrapolate, though, from that it's likely that the market is going to have increased volatility if the election is contested. Again, it's not definitely going to be, but I think that it's fairly likely at this point. And markets can price anything in. So good, bad, ugly, they'll take it, they'll digest it, they'll price it in, and then we can move on. But what markets can't price in is not knowing. And that's where we're at right now. I think the market's going to struggle if we don't know who the president is. There's going to be some pretty significant volatility until that is confirmed. It's just something as an investor you need to be aware of right now. And so, we'll see. Obviously, we're about a week out. So this is definitely the time to be paying attention to your portfolio. So I said that the market's kind of ignored a lot of factors because of the stimulus and Federal Reserve intervention. So this is fascinating to me. So we've had multiple revisions of S&P 500 estimates of earnings since January. We've gone from $171 a share all the way down to $135 a share. So that is significant. When we look at the valuation of the S&P 500 has fallen dramatically, yet prices have continued to kind of to escalate and go up. So I think what could happen, what's very likely, is if at some point investors are going to say, why am I paying a premium for something that continues to be valued less? Because before it was a little easier to defend with, it seemed like endless stimulus was coming. And so now we kind of have to come to grips with some of the things that are happening in the economy. I think that it's likely when we look at GDP, we're going to see a very big pop in GDP for this quarter. Obviously, if you shut down being able to manufacture and then all of a sudden you open everything up, of course there's going to be a big pop. We will probably still be below where we were, though, pre-pandemic. And, COVID cases are surging, and so that's another headline that some people are saying, hey, the market's responding to the uncertainty that we're surging. Hospitals in Utah are saying they're reaching capacity. What's this going to mean for the economy? Are states going to have to shut down? I know Chicago just shut down indoor dining, and so, hey, what's this going to mean for us? Certainly going into the winter, that's an uncertainty. We don't know what that's going to mean, so the market may skid a little bit without trying to kind of make that determination. Again, we've never been so far disconnected. The market and GDP and the economy have never been as disconnected as they are right now, just to kind of show you here. So actually GDP had kind of started to trail off back in 2018. Here we are in 2020, yet the market for a while was just kind of continuing to truck on. And so it'll just be interesting to see, at what point do they have to be reconciled? Because they will have to reconcile eventually. The question is, though, how long can we allow these other interventions to kind of continue to prop up the market? It's part of the reason why we've remained somewhat defensive. So while, yes, we are in the market, we've made sure that we've had a lot of hedges along the way because we didn't think that, we had the all clear yet. But what I do want to spend a couple minutes with you is just kind of show you, though, how it works. That if you have areas of positive momentum and you're invested in areas of positive relative strength, you can afford to be more conservative and defensive when you need to be, kind of sit out on the sidelines, because if you're in the right areas, you'll be able to outperform the markets over the long run anyways. And so what I did was I pulled all of our equity funds and I just did the past 30-day performance numbers for all of them and the S&P 500. So the S&P 500 performance numbers for 1 month, same time as all these, was 2.91%. For 30 days. So our innovative technology fund for the exact same time period is up 8.29. Our online retail fund is up 10.43. Our consumer discretionary fund is up 5.04. Our building construction industrial fund is up 4.42. Our large cap growth fund up 3.73. Our mid cap growth is up 8.74. And our small cap fund is up 8.78% for that same time period. And so again, we have small bites of the apple, so we are in the market. And I'm not saying that you need to go to cash right now. I guess what I'm saying, though, for investors is that this is the time that you really need to be paying attention to your portfolio. If you didn't take the opportunity back in early October to kind of trim holdings and take profits and add hedges, at this point I would be looking for a reflexive rally in the market, a bounce, which we may see in the next few days, to maybe take those opportunities to do so, get rid of any laggards, and really be paying attention here, because I think that we're going to be facing some great uncertainty, at least in the short run. I think in the long run the market will recover, and we will, as a nation, we're going to recover, and that things will be okay, but for certainly in the short term, this is the time for investors to pay attention. We are certainly paying attention to the technicals very carefully right now with our client portfolios, in case we do need to make any changes in the next few weeks. And so I thank you for joining us. And I know that these can be unsettling times. So if you ever have a question for me, you can always email me, ashleyr@victoryfiduciary.com. I do write a monthly blog that you can find on our website, victoryfiduciary.com. Again, I love the opportunity to speak with you or answer any questions that you have. And I just hope that you continue to enjoy these videos and stay safe, and we'll see you next week.